These incredible money-making machines can create a steady stream of income while you sip your favorite latte and enjoy life's pleasures. And the best part? You don't need to be a millionaire or have a PhD in finance to get started. In today's video, I will be sharing with you not one, not two, but 10 incredible passive income cash flow assets that can put money in your pocket effortlessly. We'll explore assets that generate consistent cash flow for months and years, allowing you to say goodbye to the paycheck-to-paycheck cycle and hello to financial abundance. You'll discover the power of smart investments, where your money works tirelessly for you. We'll delve deep into each asset, explore their inner workings, and the potential cash flow they can generate. Whether you're a young professional looking to escape the rat race, a family person striving for financial security, or someone preparing for a comfortable retirement, this video has something for everyone. Let's get right into it. 1. Annuities. Annuities are financial products offered by insurance companies that provide a guaranteed stream of income over a specified period or for life. The most common types of annuities are fixed annuities, variable annuities, and indexed annuities. With a fixed annuity, you'll receive a predetermined, fixed income amount for a specific period or for life. This offers stability and predictability in your cash flow. On the other hand, variable annuities allow you to invest your premiums in a selection of investment options, such as stocks and bonds. The income you receive will depend on the performance of your investments. Lastly, indexed annuities are linked to specific market indices, like the S&P 500. Your income payments will be based on the performance of the index, providing a balance between growth potential and downside protection. This is how annuities can generate passive income. Suppose you're 60 years old and decide to purchase a fixed annuity with a $500,000 premium. The insurance company offers a guaranteed interest rate of 4% for life. With this annuity, you can expect to receive $20,000 per year in passive income. This income will continue as long as you live, providing a stable cash flow throughout your retirement years. In another scenario, let's consider a variable annuity. You invest $500,000 in a variable annuity that offers a range of investment options. Over the years, your investments perform well, and on average, you achieve an 8% annual return. With this growth, your annuity can generate a higher passive income where you will receive an annual income of $40,000. Keep in mind that variable annuities come with more risk due to market fluctuations. Indexed annuities provide a different approach. Let's say you choose an indexed annuity that tracks the performance of the S&P 500. If the index gains 10% in a particular year, your annuity may provide a portion of that growth as income. For example, if the annuity has a participation rate of 80%, you'll receive 80% of the index's growth, which would be $8,000 in this case. Indexed annuities offer the potential for higher income based on market performance, while still providing some level of protection. It's important to consider various factors when evaluating annuities. The interest rates, fees, and surrender charges can impact your overall return. Additionally, payout options play a role in determining your income. For instance, if you opt for a joint life annuity, where payments continue to your spouse after your passing, the initial income amount may be lower compared to a single life. 2. Private credit investments. Private credit refers to loans or debt investments made directly into non-publicly traded companies, typically by institutional investors or accredited individuals like yourself. These investments can offer attractive yields and diversification opportunities beyond traditional fixed income investments like bonds. When you invest in private credit, you essentially become a lender, providing capital to borrowers who require funding for various purposes, such as business expansion, acquisitions, or real estate development. The borrowers agree to pay interest on the loan, which becomes a source of passive income for you. Private credit investments come in various forms, such as direct lending, mezzanine debt, distressed debt, or asset-backed lending. They typically involve working directly with borrowers or investing in specialized funds managed by experienced professionals who analyze and underwrite these investments on your behalf. These investments are made through private credit funds or direct lending platforms. Imagine you invest $90,000 in a private credit fund that targets an annual return of 6%. This fund focuses on providing loans to small and medium-sized enterprises, SMEs, in the technology sector. The fund manager conducts thorough due diligence and selects creditworthy borrowers with solid business models and growth potential. As an investor in the fund, you receive monthly or quarterly interest payments, depending on the fund's distribution schedule. Assuming a quarterly distribution, your $10,000 investment could generate $1,350 in interest income per quarter. This translates to approximately $5,400 in annual interest income. Private credit investments come with certain risks. The creditworthiness of the borrowers and the economic conditions can impact the performance of these investments. That's why the fund manager mitigates these risks through rigorous underwriting, diversification across multiple borrowers, and active monitoring of the loan portfolio. To provide further protection, private credit investments may be structured with collateral or secured by the borrower's assets. This collateral can help recover a portion of the investment in the event of a default. Private credit investments can be a lucrative avenue for generating passive income and diversifying your investment portfolio. By lending to privately held companies or individuals, you can earn attractive yields. 3. Value shares. Value shares, also known as value stocks, are shares of companies that are considered undervalued by the market. These companies often have strong fundamentals, stable earnings, and attractive dividend yields. Investing in value shares for passive income can be an effective strategy for generating cash flow. The primary source of passive income is dividend payments. Dividends are a portion of a company's profits that are distributed to shareholders. Value shares tend to have a higher dividend yield compared to growth stocks, making them attractive for income-focused investors. The amount of dividend income you receive depends on factors such as the company's profitability, dividend payout ratio, and the number of shares you own. Suppose you invest in a value share of LED Company, which is currently trading at $50 per share. LED Company has a history of paying consistent dividends and has declared a dividend of $2 per share for the quarter. If you own 100 shares of LED Company, you would receive a dividend payment of $200 for that quarter. Additionally, some value companies have a history of increasing their dividend payments over time. This is known as dividend growth. For example, let's say the value company you invested in has a dividend growth rate of 5% per year. In the first year, you receive $800 in dividends. In the second year, assuming the dividend growth rate holds, you would receive $840. Over the long term, this compounding effect can significantly increase your passive income. Before investing in a company for its dividend income from value shares, it's crucial to assess its financial health, earnings stability, and cash flow generation capacity. Remember, in some companies, dividend income is not guaranteed. Companies can choose to increase, decrease, or even suspend their dividend payments based on their financial performance and other factors. So, look for companies with a track record of increasing dividends over time and a reasonable payout ratio. A sustainable and growing dividend is key for long-term passive income generation. 4. High-yield savings account. A high-yield savings account is a type of savings account that offers a higher interest rate compared to traditional savings accounts. These accounts are typically offered by online banks or financial institutions that operate with lower overhead costs. Investing in a high-yield savings account can be an attractive option for individuals seeking to earn passive income while maintaining a low-risk and liquid investment with a steady income. Suppose you open a high-yield saving account with an annual interest rate of 2%. You deposit $10,000 into this account. Over the course of a year, you would earn $200 in interest. This interest income is considered passive income as it is generated from your deposited funds without requiring active involvement or effort. The interest earned on a high-yield savings account is typically compounded daily or monthly, which means you earn interest not only on your initial deposit but also on the interest you have already earned. This compounding effect can help accelerate your passive income growth over time. To maximize the benefits of a high-yield savings account, to automate your savings. Set up automatic transfers from your checking account to your high-yield savings account on a regular basis. This way, you consistently contribute to your savings and take advantage of the compounding interest to grow your passive income over time. Remember, everyone's financial situation is unique. So consult with a financial advisor to determine how high-yield saving accounts fit into your overall financial strategy. 5. Certificate of Deposit. Certificates of deposit are fixed-term savings accounts offered by banks and credit unions. They provide a safe and predictable way to earn interest on your savings while preserving your principal investment. When you invest in a certificate of deposit, you agree to leave your money deposited for a specific period, known as the term or maturity. The bank pays you a predetermined interest rate on your deposit, and at the end of the term, you receive your initial deposit along with the interest earned. Certificates of deposit are considered low-risk investments because they are insured by the Federal Deposit Insurance Corporation, FDIC, in the United States, or the equivalent agency, up to certain limits. Certificates of deposit offer different term options, ranging from a few months to several years. Generally, the longer the term, the higher the interest rate offered. However, keep in mind that certificates of deposit have a fixed term, and withdrawing your money before the maturity date may result in penalties or loss of interest. To see how certificates of deposit can generate passive income. Suppose you decide to invest $10,000 in a 2-year certificate of deposit with an annual interest rate of 2.5%. At the end of the term, you would receive your initial deposit of $10,000 plus the interest earned, which amounts to $500 each year since the interest is usually paid out periodically either annually or semi-annually. This interest payment represents your passive income from the certificates of deposit. To maximize more on your passive income, you may consider a strategy called certificate of deposit laddering. With certificate of deposit laddering, you divide your total investment into multiple certificates of deposit with different terms. For instance, instead of investing $10,000 in a single 2-year certificate of deposition, you could invest $2,000 each in the first year, second year, third year, fourth year, and fifth year. As each certificate of deposit matures, you can reinvest the funds into new certificates of deposit with the longest term, potentially capturing higher interest rates over time while maintaining a portion of your investment accessible. Certificates of deposit are known for their stability and low risk, making them an attractive option for conservative investors seeking a predictable and consistent cash flow. 6. Digital products. Digital products are intangible goods that can be delivered electronically, such as e-books, online courses, templates, software, and digital artwork. They offer a unique opportunity to create passive income by leveraging your skills, expertise, and creativity. These products offer the potential for passive income as they can be created once and sold repeatedly without the need for physical inventory or ongoing production costs. As long as there is demand for your product, you can continue to earn passive income from each sale. This scalability is one of the major advantages of digital products as a passive income asset. Creating and selling digital products requires effort and investment upfront. You need to invest time and resources to develop high-quality products that provide value to your target audience. To enhance your income potential, you can offer upsells or additional products and services related to your digital products like customizable templates. These upsell can further boost your passive income. To effectively sell digital products, you'll need a platform or marketplace to showcase and distribute your offerings. There are various options available, such as your own website, e-commerce platforms like Shopify, or specialized marketplaces for digital products like Amazon KDP and Etsy. Consider factors such as ease of use, payment processing, and the ability to reach your target audience when choosing a platform. When pricing your digital products, you want to strike a balance between affordability for customers and profitability for yourself. Consider implementing measures such as watermarking, encryption, or licensing agreements to safeguard your intellectual property. 7. Index funds. Index funds are a type of investment fund that aims to replicate the performance of a specific market index, such as the S&P 500 Worldly in the USA, iShares Core FTSE 100 ETF in the UK, and the S&P/TSX in Canada. Investing in index funds can provide a convenient and low-cost way to passively participate in the overall performance of the stock market. When it comes to generating passive income, index funds primarily offer two sources: dividend payments and capital appreciation. Dividend payments. Many companies included in market indexes distribute a portion of their earnings as dividends to shareholders. When you invest in an index fund, you indirectly become a shareholder of all the companies in the index. As a result, you receive a proportionate share of the dividends paid by those companies. Dividend payments can provide a consistent stream of passive income. Capital appreciation. Index funds also offer the potential for long-term capital appreciation. As the companies within the index grow and increase in value, the price of the index fund shares generally rises. If you hold the index fund for an extended period, you may benefit from capital appreciation when you decide to sell your shares. Index funds offer diversification across various sectors and companies, reducing the impact of any individual stock's performance on your overall investment. 8. Stocks. Stocks, also known as equities, represent ownership in a company. Investing in stocks can provide the opportunity for capital appreciation and regular income through dividends. When you invest in stocks, you become a shareholder of the company. Some companies distribute a portion of their profits to shareholders in the form of dividends. Dividends are cash payments made by the company to reward investors for their ownership. These dividend payments can serve as a source of passive income. Dividend yields can vary among different stocks and sectors. Companies with a history of stable earnings and a commitment to distributing dividends are often favored by income-oriented investors. Therefore, it's crucial to conduct thorough research on the company's dividend history, payout ratio, and financial health before investing in passive income. When selecting stocks for passive income, it's important to focus on companies with a solid financial foundation, a history of consistent dividend payments, and the potential for future growth. Diversification is crucial when investing in stocks for passive income. By spreading your investments across different sectors and industries, you can reduce the risk associated with individual companies. This helps to maintain a more consistent cash flow and protects your portfolio from potential industry-specific or company-specific challenges. 9. Intellectual property. Intellectual property refers to creations of the mind, such as inventions, patents, trademarks, copyrights, and trade secrets. Investing in intellectual property can provide a unique avenue for generating passive income. One of the most common forms of intellectual property is a patent. Patents grant exclusive rights to inventors for their inventions, allowing them to prevent others from using, selling, or profiting from their creations without permission. The beauty of intellectual property is that once you have established licensing agreements, you can earn passive income without being directly involved in the production, marketing, or distribution processes. In addition to patents, trademarks can also provide passive income opportunities. Trademarks are distinctive signs, symbols, or words that identify and distinguish products or services from others in the marketplace. By registering and licensing your trademark to other businesses, you can generate licensing fees or royalties. Copyrights are another form of intellectual property that can generate passive income. They protect original works of authorship, such as books, music, artwork, and software. By licensing your copyrighted works to publishers, record labels, or software companies, you can earn passive income through royalty payments or licensing fees. To successfully generate passive income from intellectual property, it's essential to protect your creations through proper legal channels. This may involve working with intellectual property attorneys or specialists to file patent applications, register trademarks, or copyright your works. 10. Real estate franchise. Real estate franchises offer a unique opportunity to invest in the real estate market while leveraging the brand recognition, systems, and support provided by an established franchise. When you invest in a real estate franchise, you become part of a network of franchisees who benefit from the brand's reputation and marketing efforts. The franchise typically provides training, operational support, and access to resources that can help you navigate the real estate market more effectively. One of the primary ways real estate franchises generate passive income is through rental properties. As a franchisee, you have the opportunity to purchase and manage rental properties within the franchise's designated territory. For instance, you invest in a real estate franchise and purchase a rental property for $200,000. After accounting for expenses such as mortgage payments, property taxes, insurance, and maintenance costs, your net operating income (NOI) from the property is $20,000 per year. This represents the income generated from rental payments minus the property-related expenses. Now, it's important to note that the actual income and expenses may vary based on factors such as property location, market conditions, and tenant occupancy. However, real estate franchises often provide support and guidance to help you make informed decisions and maximize rental income. Another aspect to consider is the potential for property appreciation. Over time, real estate properties have the potential to increase in value. This appreciation can contribute to your passive income if you decide to sell the property in the future. When evaluating real estate franchises, it's essential to consider factors such as the franchise's reputation, track record, and support systems. Look for franchises that have a strong brand presence, a proven business model, and a supportive community of franchisees. Conduct thorough due diligence, review the franchise agreement, and seek advice from professionals such as real estate attorneys and financial advisors. Generating passive income is a powerful way to build wealth and achieve financial freedom. I appreciate each and every one of you for taking the time to watch this video. If you enjoyed it and found it helpful, kindly consider giving it a thumbs up and subscribing to the channel to stay updated with future videos on personal finance, investment strategies, and wealth building techniques. Take care, stay focused on your financial goals, and keep working towards that passive income cash flow.